Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. According to a new report published by the Institute of Finance and Banking at the Chinese Academy of Social Sciences in Beijing, Chinese households have reported increasing indebtedness as well as heightened levels of income and job insecurity. The report warns, quote, "Given the debt stress, residents are more likely to use their savings to pay off debt to reduce asset risks than to consume and invest due to their more pessimistic expectations of future economic growth." End quote. Now, we've already seen several reports from private individuals, analysts, and banking institutions that suggest the same conclusion. This is the first major report from a state-run think tank to make this point, however. And these feelings amongst Chinese households appear to be well placed. China's official household debt rate reached 63.5% of the national gross domestic product, GDP, in the second quarter of this year, up from 61.9% at the end of last year, and well over $10 trillion. This is largely made up of mortgages, but also includes consumer goods loans, credit card debt, and other private borrowing. For reference, the IMF has identified 65% as a red line warning point for financial risks. The average of emerging economies, which are more susceptible to financial crisis, is 47.7%, the US is 74.4%, and Japan is at 68.2%. These comparisons are somewhat misleading, however, as in China, households receive some of the lowest proportions of national GDP in the world. When measured as household debt as a percentage of household disposable income, the situation looks much more serious, shooting past US household debt levels several years ago. The Chinese household leverage ratio has traditionally been quite modest. However, like so much leverage in the overall system, the rate rose rapidly after 2008 when Beijing launched a massive stimulus package. The systemic issue of sustained sky-high housing prices has also forced households to turn to ever larger mortgages, though this trend has slowed in recent years due to the housing crisis. The Institute of Finance and Banking report argues that excessive levels of indebtedness and slow income growth among Chinese are constraining consumption, something policymakers desperately are trying to stimulate. We remember from earlier this week, the powerful National Development and Reform Commission announced a series of measures, mostly supply side, to do just that. Analysts, however, are mixed in their views as to whether these measures will see much success. For example, the Economist Intelligence Unit, in an opinion published on Tuesday, warned that these measures will, quote, "have limited effectiveness." End quote. On the same day, we quoted on China Update one finance expert as expressing that, quote, "most of these measures don't expand consumption at all. What all these measures miss is that the total consumption of Chinese households is limited by their household budgets, which is in turn limited by disposable household income." End quote. As we just examined, Chinese households enjoy a very low share of GDP compared to other countries. Low income means low consumption, unless one uses debt, which, unless it results in productivity gains, also reduces future consumption when bills become due. And as we can now see, debt is already too high. Zero COVID also savaged household consumption, smashing household confidence and incomes. Consumption contributed only 32.8% of China's GDP growth in 2022, down from 58.3% in 2021. This also tells us that the composition of 2022's growth was likely unhealthy, with infrastructure spending making up for most of the consumption shortfall, though some was represented through exports, which is a healthier driver. We remember that China's outstanding mortgage loans dropped 0.8% in the second quarter from a year earlier, the first decline in more than a decade. Thus, policymakers not only have to increase consumption generally, but they also need to repair households' battered confidence too. Okay, we're going to move next to two more developments, but before I do, I just wanted to let everybody know that I may be in Shanghai in a few weeks in the Jing'an/former French concession area. I would love to meet up with viewers who live in Shanghai who would be interested in meeting perhaps in the evening, a dinner or some sort of event. If you would be interested in this, if you're based in that area in Shanghai, my channel email is in the description below. Flick me off an email with just a little bit of information and what times you're available. And if I do make the trip, I will make sure to get in touch. And while we're here, if you're enjoying today's episode, don't forget to hit that like button. Sharing and subscribing is a massive help, especially sharing with people who you think may enjoy this sort of content. It's the best way for the channel to grow. And for anyone who can go the extra mile, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Next up, this week, the head of the Department of Auditing of Hainan Province, a low-income, low-population island province in the south of the country, released an audit on how temporary medical facilities, makeshift hospitals, and other resources employed during the zero-COVID years have been abandoned. The report explains how hundreds of millions of yuan worth of facilities and equipment have either been thrown away or left to rot. This is quite a frank report on an issue facing local governments across the country. During the zero-COVID years, local governments were expected to roll out massive programs to monitor and test hundreds of millions of people. At the time, much of this was financed with instruments usually designed for infrastructure work, which, in theory, would pay for themselves over time. This was never going to be the case with these temporary facilities, however, but at the time, local governments had no choice but to take marching orders from the party core. In December of last year, the National Health Commission required regions to upgrade and repurpose temporary hospitals into new fixed hospitals. But for most, this hasn't been possible. The Hainan report, which was delivered by the head of the department, says that equipment and supplies were damaged after being left out in the open, subsequent to the dismantling of 9 makeshift hospitals, with testing booths and isolation wards being left abandoned. According to Chinese financial media outlet Caixin, which provided its own article on the report with relevant interviews with other third parties, there were 5 cities and counties where a total of 5,586 isolation wards worth 370 million yuan, $52 million, have been left unused. One county reported that nearly 200 air conditioning units and televisions allocated for these rooms were unaccounted for. 9 cities and counties had a total of 665 testing booths with nearly 30 million yuan left abandoned, while 12 cities and counties, the article continues, had pandemic prevention supplies worth around 61 million yuan, which were about to expire or had already expired. Similar issues are being seen across the country. Chinese financial media outlet Yitai Global writes that Guangdong, China's most populous province, spent 71.1 billion yuan, $10 billion on makeshift testing facilities. Eastern Zhejiang province, population 65.8 million, spent 43.5 billion yuan on control measures. Beijing, the capital, 30 billion RMB. But of course, as economists remind us, this is all trivial compared to the massive costs caused to the economy by shutting down large parts of the country periodically for 3 years. Costs which are still being very much felt today. And these costs are almost impossible to quantify, but even the most conservative estimates put the opportunity costs alone in the trillions of yuan. And finally, for today's episode, markets appear to be excited about the Politburo's recent and quite rare commitment to, quote, invigorate capital markets and boost investor confidence, end quote, which in previous years has meant that the state is prepared to promote China's $10 trillion stock market through a set of statements and actions, triggering, it is hoped, a bull market. Indeed, more than one analyst has called the pledge the strongest endorsement of markets by top leaders in the last decade. In the past, statements to support the capital markets were made by top government bodies, not the top party one. Some investors are now betting that there is money to be made, in the short term at least. Today, Friday, key equity gauges in mainland China and Hong Kong rallied after markets learned that regulators are meeting with onshore securities firms on possible initiatives. One thing on the wish list is for a lower securities trading stamp duty. Lowering the 20% levy on dividend income from stocks that have been owned less than 1 month is also a popular request. US financial media outlet Bloomberg writes that domestically,
Authorities could also encourage more equity investment by insurance firms, as well as the national pension and social security funds. China's 385 billion yuan mutual fund industry, the outlet writes, is seen as another key source for market growth as households look to transition wealth from the troubled property market into other investments. With this topic, let's end today's video with this observation from our old friend, Professor Michael Pettis. Quote, "When Beijing seems determined to force up the stock market, investors usually see that as a signal to buy, and their decisions become self-reinforcing as purchases can cause markets to shoot up. We saw this most dramatically in 2007 and 2015. The problem is that this is mostly speculative buying. Investors rush into the market not because of fundamental improvements in the business outlook, but rather because of credible signaling by the regulators, and speculative buying eventually leads to speculative. My guess is that Chinese stock markets will probably do well over the rest of this year, as Beijing makes it increasingly clear that it will do whatever it takes to cause prices to rise. But after the terrible experience of 2016, investors will also be quick to sell. In spite of self-interested claims by large funds, Chinese markets are driven mainly by speculative investing, not by fundamentals, and ironically, regular government signaling and intervention is part of the reason." End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Friday, have a great weekend, and I will see you all tomorrow.